Okay, folks, welcome back. This is price action model number 4, position trading trade plan, and it's targeting 500 plus pips per trade. Okay, so the ICT price action model number 4, position trade plan, again targeting 500 pips per trade. As always, we start with our initial slide here that gives us an overview of the process. And you've seen this now 3 previous times, and it'll look like this every single time we do a trade plan. But it always starts with preparation, and then the next stage is opportunity discovery, trade planning, trade execution, and finally trade management. Okay, for trade preparation, again, we are always referring to the economic calendar for the coming week. We're going to be noting all medium and high impact events for the markets that you will be following. You're going to study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Now, since we're looking at position trading, we're focusing primarily on that monthly chart and looking for seasonal tendencies, as we'll talk about later on in this trade plan. But we're looking at how the independent daily economic drivers and volatility injections that the economic calendar will provide us that may be the smoke screen, if you will, to facilitate the manipulation that starts these longer term trades. Every component you've seen so far in swing trading, short-term trading, and intraday trading trade plans, the smaller short-term time frames, those trade plans can be plugged in to the higher time frame trade plans. So it just makes it more convenient in terms of managing risk. And then we'll mention that when it comes to that time where the trade plans could be integrated for reducing risk. But for now, just know that everything starts the same way. So it's not like we're changing everything because it's a new model or a duration of trade plan. It's the same protocols and procedures, and it's refined to a specific process and what we look for each independent model. They will agree as a whole, as a collective whole. Once you know all 12 models, you'll be able to see how they can be interwoven to create a really complete overview of price action. Okay, and the next stage of preparation is we're going to be determining the IPTA data range for the last 20, 40, and yes, for position trading, 60 days trading days. We do not count Sundays, and we're going to note the highest high and the lowest low in the past 20, and the 20 is got a little asterisk there because, again, you're going to do this for all 3 IPTA data ranges, the 20, 40, and up to 60 trading days. And this is going to be your current dealing range. So again, the date, whatever the day's date is, we count that day and look back 20 days, 40 days, and 60 days, and whatever that is, that's our IPTA data range. Again, 60 days is the furthest we'll go back, and we'll be looking for setups within that range. Highest high and the lowest low will give us that dealing range, and we will refer to it for our PD array matrix. Now inside this dealing range, we will look for the next draw on liquidity. Where is price likely to trade to next? An old high, low, fair value gap, or liquidity pool. But the focus is a minimum of 500 pips. So many times you're going to find yourself reaching for that 60-day IPTA data range to get that 500 pips. We will look for a PD array in the direction of the monthly range bias, premium PD arrays when bullish, and discount arrays when bearish. We anticipate price to move to a PD array that would support our monthly bias on a day and economic event found on the economic calendar with the current or next trading week. This is what we wait for. This can either be a run on liquidity or rebalancing to inefficient price delivery. We identify the current seasonal tendencies for the time of your price action study. Now, when we went through the core content, I gave you a teaching on the commodity markets, and I also introduced seasonal tendencies in month 5. There's also teaching where I did mega trades. Okay, so you want to go back through the core content and go through the mega trade portion. And I go through there and I pick out my personal choice of the best seasonal tendencies throughout the year. So what you need to be doing is, if you're going to be using a model like this, it's a long-term position model, if you go through all the markets and look for their strongest seasonal tendencies throughout the calendar year, and then when you start a brand new trading year in January, during Christmas break, you can do this, or the first couple weeks of January when we don't generally trade because the markets have to work off that low volatility and holiday rut that it's typically seen. You want to be planning each month what market you anticipate, not that you demand it has to happen, because seasonal tendencies are just a roadmap. It's not a panacea. It's not going to always be there. It's just a general rule of principle in terms of direction, okay, or a bias for a long-term expected roadmap, what generally happens more often than not. So I kind of like gave you the longest-winded definition of a seasonal tendency that you've probably ever heard, but I really want to press upon you the importance of just knowing that seasonal tendencies, while they're nice and they're great and they're very useful, they're not always perfect or accurate. Okay, so there's going to be times where they're not going to pan out. That's where risk is incurred. That's why we have to have stops. That's why we don't over leverage. Otherwise, we just go full hilt, go in there, no stops, and just expect it to pan out, and everybody would be billionaires. Wouldn't that be fun? But it's not like that. So nonetheless, you want to go through those lessons I just outlined. The month 5, where I introduce seasonal tendencies. You want to look at the commodity section where it goes over specific seasonal tendencies there. And then the mega trades. Mega trades lesson gives you the choicest setups for seasonal tendencies. So between those 3 areas going into the core content, it'll help you really dig deeper into this trade plan. But we're looking for the seasonal tendencies for the month to come or the next quarter. Okay, so this really is a quarterly shift model, okay, and trade plan. So it's really designed to trade for moves that are around 2 months or longer, and that's really focusing on the quarterly shifts that we talked about during the core content. So focusing on only the highest probability seasonals that suggest a strong chance of bullishness or bearishness at that current time, that could offer 500 pips or more. Okay, so you're looking for a setup within a range that will allow or suggest that it could deliver as many as 500 pips or more. And that means that you're going to be looking at monthly and weekly charts, okay, to help frame out that 60-day IPTA data range. But you're going to be limiting your focus to the highest probability seasonal tendencies. You're going to identify the discount arrays under the IPTA data range of 20, 40, and 60 when the bias is bearish. And you're going to identify the premium arrays inside the 20, 40, and 60-day IPTA data range when the COT hedge program is bearish. Expect a monthly range expansion down. You're going to identify the premium arrays above the 20, 40, and 60-day IPTA data range when the bias is bullish. Identifying the discount arrays inside of the 20, 40, and 60-day IPTA data range when the COT hedge program is bullish. Expect a monthly range expansion up. When the market is primed, we want to look for a convergence of both manipulation in price opposite to our trade bias at a time when the economic calendar suggests a volatility injection will likely unfold. We will short premium fair value gaps and buy discount fair value gap setups. When we are bearish, we will frame a short entry when price has moved up into a 4-hour premium fair value gap PD array that that converges with a standard deviation of no more than +3 standard deviation during London or New York Open. We can implement scalping protocols on this stage as well for further reduction in risk. What do I mean by that? You can go into the scalping trade plans and that model and plug in right here to help refine the risk down to the smallest possible 1-minute chart. When we're bullish, we will frame a long entry when price has moved down into a 4-hour discount fair value gap PD array that converges with a standard deviation of no more than -3 standard deviation during London Open or New York Open. We can implement, again, as I mentioned in the previous slide, the scalping protocols at this stage for further reduction in risk. When we are bearish, we will target the sell side liquidity below any old daily or weekly low or discount fair value gap inside of the 20, 40, or 60-day IPTA data range. The next logical discount array at 500 pips will be the initial objective. There will likely be multiple old daily or weekly lows inside of the IPTA data range, but we use the one that frames the potential of at least 500 pips. When we are bullish, we will target the bullish liquidity above any old daily or weekly high or premium fair value gap inside of the 20, 40, or 60-day IPTA data range. The next logical premium array at 500 pips will be the initial objective. There will likely be multiple old daily or weekly highs inside of the IPTA data range, but we use the one that frames the potential of at least 500 pips. When we are bullish, we will note the European Open price on Tuesday. Now, the Tuesday day here, this could be a Monday or it could be a Wednesday. We're focusing on that weekly profile. If we're bullish, we're expecting the low to form between Monday and Wednesday's New York Open. So anywhere in there, that's our typical window opportunity where the low can form. But I'm sticking with this because Tuesday generally, as I teach even from the free content, there's a 70% chance that Tuesday creates a low of the week when the market is bullish. So if we're expecting a weekly profile to be bullish and higher prices to be delivered, generally the highest odds will be on Tuesday. It doesn't mean that it can't form on Monday, and you should be looking for it as well on Monday. But nonetheless, if you lose or get stopped out on Monday, you go right back in on Tuesday. And the same thing we said, if you lost or got stopped out on Tuesday and the trade still looks good based on all the things that we would outline in this model, then Wednesday could be used as well. Okay, but we're using just a general rule, but just replace Tuesday with Monday and or Wednesday. Okay, the European opening price on Tuesday, and filter all longs at or below this price level, which overlap, and here's the key, which overlap in the 4-hour discount fair value gap. Okay, so if the opening price, your European price, okay, is filtering your entry and it overlaps with your 4-hour discount fair value gap, you really have a beautiful setup right there. We will anticipate a 15-minute chart institutional order flow entry drill trade entry to form inside of a retracement lower during London Open and or New York Open kill zones, or a sell stop raid. Either one could be used. When we are bearish, we will note the European opening price on Monday, Tuesday, or Wednesday, and filter all shorts at or above this price level, which again overlap in the 4-hour premium fair value gap. We will anticipate a 15-minute chart institutional order flow entry drill trade entry to form inside of a retracement higher during London Open and or New York Open kill zones, or our standard buy stop raid. When we are entering a short, we will place a sell limit order on all positions we will execute with our demo account. We will use the standard deviations and PD array convergence minus 5 pips as our entry price when using the sell limit order. If multiple orders are used, all use the same entry price in the sell limit orders. When we are entering a short, we will place a limit order to take 100 pips as our objective on one position. We will place a second limit order to take 250 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture a 500 pip objective, make sure you close 80% of the trade. That means nothing from the total amount of trade position size that you have on and all the orders that you have. 80% must be closed across all orders or total position when you get 500 pips. Then see if you have any more room to run in price. When we are entering a short, we will note the premium array and standard deviation convergence we aim to enter at. We will place our stop loss above this high plus 25 pips. We will re-enter if the trade stops out. We can monitor it for a secondary entry. Position trades may require multiple attempts to secure a solid entry. Do not fear this. When we are entering along, we will place a buy limit order on all positions we will execute with our demo account. We will use the standard deviation and PD array convergence plus 5 pips as our entry price when using the buy limit order. If multiple orders are used, all use the same entry price in the buy limit order. When we are entering along, we will place a limit order to take 100 pips as our objective on one position. We will place a second limit order to take 250 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture a 500 pip objective, close 80% of the trade and see if it has more room to run. Now, what's not being said here is obviously I'm mapping out using multiple orders, whether being long or short. And one of the orders you want to take out 100 pips. Make it simply just 100 pips that you get out, regardless of how fast it's moving. Put your limit order to exit at 100 pips profit. Your second order, you're going to do the same thing, but have it set to take 250 pips out. Your third, or if you have multiple orders beyond 3, okay, if you have just 3, then you have to consider that third one taking 500 pips, take profit there, but make sure that whatever you term as a scaling or whatever you're taking as a partial, okay, at that last order for 500 pips, make sure that 80% of that existing remaining balance of long or short, 80% of it's off. So that way you only have 20% of that last portion on in terms of risk. So you've captured 500 pips, you've got the lion's portion of the move behind you. You've also taken 250 pips on one other order and 100 pips after another order. So you really fed yourself a great deal of profit and pips. And you don't want to leave a lot to risk in terms of seeing it reverse on you. But you do want to see if you can have it run a little bit further. So if you had 4 orders, you can take one at 100 pips off, a second one off at 250 pips profit. A third one could come off at 500 pips and just let the other one run, but lock in, say, 400 pips and let it float for 100 pips in terms of potential risk of open profit. When we are entering along, we will note the discount array and standard deviation convergence we aim to enter at. We will place our stop loss below this low, minus 25 pips. We will re-enter if the trade stops out. We can monitor it for secondary entry. Swing trades may require multiple attempts to secure a solid entry. Do not fear this. When we are in profit, 25% of our expected objective, stop loss can be reduced by 25%. When we are in profit, 50% of our expected objective, stop loss can be reduced by 50%. The position is at 75% of the expected profit objective. Stop must be at break even. Again, we do not choke the trade. We don't strangle it. And that's the reason why we take partials. We pay ourselves as the market makes it available. And we put our stop loss in there to manage the worst case scenario so we don't take a great deal of loss in theory. But again, the markets can gap beyond your stop loss. And at that point, really nothing can really save you. Okay, and obviously these slides are always included in the trade plans, so I'm just going to go through them rather quickly, and you can pause them. using a 20 pip stop loss. Now, obviously, you have to change the math here because we're using a 25 pip stop loss, and everything that's been shown here for executing the math to get to your per pip per stop using a 25 pip stop loss and using 1.5%. I personally think 1.5% is a little too high, especially if you're trading long-term position trading, because you're trying to capture big moves and you don't want to be wrong multiple times at 1.5%. So you want to start with, in my opinion, 1%. Okay, and the next slide here, if we're using a standard lot, you can see the math as well. And if your demo account takes a loss, this is again very important. On any trade, at the full R% you assumed, drop the R% by 50%, and when the loss is recovered by 50%, you are permitted to return to the maximum R% per trade. If the reduced R% trade assumes a loss, reduce the R% by 50% until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%. You're likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not a jagged roller coaster with deep declines. All right, you're going to collect multiple sample sets with this trade plan. If you're unclear about some of the process, rewatch the lessons on this price action model and the ones I suggested inside of the teaching here. I will provide sample sets, but do not rely or wait for mine. Dig into your charts and study what was provided here. Until then, good luck and good trading.